Hello everyone, welcome back to the Tech Roundup podcast. I'm Bill Bitcoin.
And I'm Penny Payment. This podcast is brought to you by Northridge Partners, the tech investment bank with over 20 years of experience across the Asia-Pacific, covering aerospace and defense tech, software and AI, fintech, and travel tech.
Quick reminder, we're AI creations, not real humans like you. But the expertise we're sharing comes from a very real-world source. We're seeing a major shift across Southeast Asia's fintech ecosystem. Capital is becoming more selective, and investors are increasingly distinguishing between businesses built to raise capital and businesses built to endure.
We're going to look at two major examples of this shift: the recent governance reset in Indonesia's fintech sector and the evolution of payments infrastructure across all of Southeast Asia.
It's been a brutal few years for Indonesian fintech, hasn't it? We've seen high-profile governance failures, like the revenue fraud at the aquaculture unicorn e-fishery, which was once valued at $1.4 billion and backed by heavyweights like Temasek and SoftBank. That, combined with the license revocation of Investry and the collapse of platforms like CoinP2P and TaniFund, forced a long overdue reckoning.
It's a classic case of history repeating itself. Remember the infamous BRIEX mining scandal from the 1990s, where a $6 billion mining company convinced the world it had found the largest gold deposit in history, only to be found out later that it had largely salted core samples with gold dust. Whether it's gold or fintech, the ingredients of grand claims and credulous capital remain the same. But here's the core message. These scandals are context for a much healthier evolution. Capital isn't actually disappearing from Indonesia. It's concentrating into category leaders rather than just funding broad categories.
Right. The era of growth at all costs is over, replaced by a sharp focus on capital efficiency and profitability. And it's important to be clear, this is a repricing of risk, not a rejection of Indonesia. The structural opportunity is still enormous. Indonesia remains one of Southeast Asia's most attractive fintech markets, supported by strong digital adoption, financial inclusion opportunities, and a sizable SME financing gap.
You are right, Bill. The opportunity is still massive. In fact, the ecosystem is getting stronger. What has changed is the quality threshold to capture this opportunity. And this brings us to our second story, because the same underlying shift is playing out in payments, just in a different form. Indonesia's governance reset is about markets stopping to reward companies that simply raised capital. The payments evolution is about markets stopping to reward companies that simply process transactions. In both cases, the winners are the ones building something that is genuinely hard to replace.
We've reached a point where digital payment rails are basically a commodity. Every major market has its own real-time system now: QRIS and BI-FAST in Indonesia, PayNow in Singapore, PromptPay in Thailand, Do It Now in Malaysia, and InstaPay in the Philippines.
Because these systems have lowered the cost and complexity of moving money, that defining challenge of getting merchants and consumers onto digital rails is largely finished. The question now isn't who can accept a payment, but who sits inside the business infrastructure behind it.
Jake Lin, the head of corporate development and capital strategy at Zendit, has a great perspective on this. He notes that global investors often mistakenly treat Southeast Asia as one single blob, when in reality it's a very ugly jigsaw puzzle of different regulatory frameworks and banking relationships. He actually compares it to Game of Thrones, where every little country has its own rules you have to navigate.
Exactly. The real advantage for companies like Zendit isn't just scale, but the fact that they've already built the highways that are now too difficult for others to replicate. That infrastructure play is what makes a business defensible. The critical point is that customers are no longer relying on Zendit simply to process payments. They rely on it to run critical elements of their financial operations entirely. That's a fundamentally different and much harder relationship to walk away from.
Penny, when you are running a customer's financial operations, you aren't just a vendor, you're an integrated part of their business. We see this with Cashier too, which bundles POS software, loyalty, and inventory management for SMEs across 4 different countries. Companies are moving from the edge of a transaction to the very center of the merchant's operation.
This level of integration creates a massive moat because merchants find it incredibly difficult to walk away once their inventory and payroll are tied to the platform. it also makes the role of AI much more potent.
That's a crucial point. AI benefits companies that have the richest understanding of how a customer operates daily, which lives in the workflow data, not just a transaction log. In many ways, AI may strengthen the position of incumbents because the platforms sitting closest to merchant workflows often possess the richest operational data.
And this is where the two stories converge. Indonesia's domestic market has functioned as the ultimate proving ground for exactly these kinds of embedded, operationally complex models. Few markets in Southeast Asia force companies to solve distribution, underwriting, and collections at that scale. The ones that survive emerge with capabilities that travel well, and a depth of infrastructure that competitors elsewhere simply haven't had to build yet.
And the companies that do survive are now scaling outward as regional champions. We're seeing Credivo and Akulaku taking their lending platforms into Vietnam and the Philippines, and funding societies operating as a top SME lender across 5 countries.
The correction in Indonesia is filtering out the weak players and leaving behind a generation of scaled, multi-market platforms that are built to endure. Regulators are helping drive this shift too. The Indonesia Financial Services Authority, or OJK, has introduced higher capital requirements and stronger anti-fraud measures that have already seen undercapitalized operators exit the market.
Existing fintech firms actually welcome these stricter rules because they raise the operating bar and make it harder for poorly governed competitors to even enter. For established players who already meet the bar, this is a competitive advantage. The correction is effectively removing the excuses that weak governance and fragile business models once enjoyed.
It's a fascinating evolution to watch. We've gone from a market that rewarded anyone who just showed up to one that demands institutional credibility and deep operational embedding. Indonesia's fintech reset and Southeast Asia's payments evolution may appear to be separate stories, but they're really expressions of the same shift. Stronger businesses emerging from a more demanding environment.
Well said, Penny. Ultimately, the Indonesia fintech reset won't be remembered for the scandals of the past few years, but for the regional champions that were forged in that fire. The winners of the next decade will be defined by their depth in the data flows, not just their transaction volumes.
That brings us to the end of this episode. We hope this deep dive into the Southeast Asian fintech landscape has been valuable for your own strategic thinking.
That's right. Don't forget to subscribe to this channel and our monthly newsletter, Tech Roundup, read by thousands of founders, CEOs, board members, and investors globally. See you on the next episode, and remember, we fake humans rock!